And what I would like to do is just share with you a little bit about the last quarter when we look back. So we're about 5 months into this year. It's been quite an interesting quarter. And we really ended last year on such a high note, right? That this year already, the last 5.5 months has been quite the opposite situation. But we came into the end of last year with strong economical growth, strong market growth. I believe S&P was up about close to 24-25%. And then since the beginning of the year, my goodness, what a ride we've been on. So the things that caused most of this volatility during the first quarter and continue to go on, right, is, as you all have seen and watched so closely, is the invasion of Russia to Ukraine, what that did do to the fears of oil supply for the world, sanctions that came in, the price of oil spiking up to $130 a barrel, which is the highest it's been in about 12 years. We had the onset of inflation. It's like a cannon went off in the beginning of the year, and the inflation just started raising really fast. We are at the moment at, I think, a little bit lower expectation of what we was, maybe 8.2% on our inflation rate. But we all felt it and saw it very quickly at the gas pump and then in the grocery store and all kinds of goods that's happening. Then ongoing, the Fed's reaction to inflation, right? And probably being a little bit behind the 8 ball in making corrections on the interest rates. If I just show you this graph, and what you're looking for is, we had the big dip here in February, and then the Fed started announcing in February that they're going to take action to start raising interest rates. Because of that news, the markets came back to a strong level of recovery. The highest the S&P was for the quarter was about -2% for the year in the first quarter. And that's really the markets responding to the Fed stepping up to raising interest rates in order to try to slow the economy and therefore also reduce inflation rates. So normally when the Fed increases interest rates, the markets actually responds negatively. But in this case here, in this last quarter, also real recently, markets are responding positive because it's saying that we are taking the right measures to deal with the pain of inflation. So this is a quick recap. I'm going to look a little closer to this market again and just saying we got ongoing challenges that comes from quarter one. There's no doubt about it. I think probably for most people, the biggest pain that they're feeling is the pain at the pump, right? $4.50, close to $5 here in Florida, depends upon what kind of gas you put in. It's just getting older and older and older for most folks, and it really hits the pocketbook for most people. We're all wondering, hey, what is our government doing relative to containing inflation, and what they're doing at this point in time, obviously with raising interest rate, the last interest rate increase being much more than 25 basis points. We up this year already 75 basis points from the beginning of the year. So we raised it 0.25 in March, and then it was raising again 0.5% here about 2 weeks ago. And the Fed announcement saying that, look, we're probably going to raise interest rates another 5 to 6 times this year. Just to understand the difference of what that meant, in the beginning of the year, the Fed was announcing that they would raise interest rates maybe 3 times. As a total for the year, they were talking about 0.75%, Jeremy, if you remember, 0.75 to 1%. Some of you were with us in our State of the Market dinner that we had here in January, where Paul Peterson from First Trust was with us. We talked a lot about that, the anticipation of how many times the Fed's going to raise interest rates. And now it's accelerated due to the ongoing factor that we have inflation. Some of this inflation also has to do with supply chain issues that's still working itself out, right? So there's still a shortage of products. So it will be here with us and will continue to be here with us. And we don't know exactly when we start going to get a handle on inflation. All I could see is last week, the rate came down from 8.5 to 8.2%. Here's what I'm talking about: high oil prices and gas prices. Highest price for a barrel of gas was about $130 a barrel. We came down, I won't even say normal levels, but we came down to about $104 a barrel. It's kind of where we've been cruising this week. What's interesting is that people always think that oil works in the counter side. So if stock market goes down, prices of oil goes up. If you look from the beginning of the year, it's true. This last week has been a very, very red week for the markets in general. We're experiencing, obviously, today a little bit of a bounce back, but more about that here in a second. But even if the markets are turning, when the markets are turning very, very, very negative, like it is at this point in time, it does affect gold and it does affect the price of oil. So the Fed is trying to combat this, but free supply and demand is a big part of this too. And then also whether the Ukraine-Russia situation is going to continue to escalate or whenever that calms down, that has a part to play. Our political view around oil and clean energies will have a substantial impact also on the price of oil. More to come about that here later in our conversation about midterm elections. And obviously the Russia-Ukraine conflict. We've been doing these videos. Hopefully you've been receiving these videos on a week-by-week basis where we talk about what happens there on a day-by-day basis or week-by-week basis at least. And it looks to us at this point in time that it is not becoming a world crisis at this point in time. It is more of a crisis in Ukraine. Now, it is a crisis, yes, indeed, and it's very sad to see what happens with people's lives being displaced the way it is. We see that the world is standing unitedly in the sanctions that they are offering, but we still don't see this conflict being resolved in the next 3 months or 6 months. I think this is a longer-term conflict. It might take a year or longer to be able to be resolved. But this brings a lot of uncertainty in the markets and is allowing a lot of volatility at this point in time. So here's the Fed interest rates increases. First time, in 3 years that the Fed did raise interest rates. Again, as I said, 3 times was the projection for this year. We're up to now 7 times. So we're going to see this. And again, just another thing that creates volatility. If you look at volatility according to the VIX index, that's a popular index people look at, you can see by how much our volatility is increased. And obviously you're seeing it on a day-by-day basis. If there's anything I'm going to say over and over again, it is strap in your seat belts. We will continue to have volatility. We'll continue to have volatility for quite some time, unfortunately. I'd love to be able to be the bearer of better news. We anticipate volatility for the next 3 to 6 months to be a day-by-day issue. If we look at our overall economy, I love the PowerPoint slide here because it's tongue-in-cheek in the sense. I want to talk to you about recession and what recession really means. Recession is a word that's been thrown around a lot, and there's big fears. This is another big issue that creates volatility, but there's big fears that we are in a recession already or that we're moving into a recession. And really the technical definition of a recession is 2 quarters GDP growth that is negative. So back to back. So, for 6 months, we have negative economical growth in the United States. So in the middle of all these fears, the GDP number comes out about a month, about, I would say 40 days after the end of the quarter, the number comes out. Number came out, and in the first quarter, it did indicate a negative GDP number. Now, whether the overall economy is slowing down to the extent of having negative economical growth or not, we'll have to see in the second quarter. But a lot of economists believe that GDP number was negative because we were importing much more goods than we were exporting. That has a lot also to do with the fact that we are a consumer economy. So we all go on our internet sites, we buy stuff. People coming out of COVID, they're buying more stuff. They're coming out of isolation. If you would, a lot of times people are medicating by buying stuff, and we're not the manufacturing nation of the world. So the rest of the world, China a lot, is manufacturing and exporting to us like crazy. as a country, we feel the pains of the supply chain issues ourselves and are doing a lot of work to get ships in and containers moving, and they are moving, and it's improving on anything from a trinket down to cars, right, and major equipment. But as we're exporting stuff, a lot of our ships is really sitting still in the harbors, in countries like China that's importing from us. They have much stricter COVID restrictions, right? They're still dealing with waves of COVID. So they are not allowing these ships to come into the country. So you could quickly see the disparity between imports and exports. Now, that's what, for the most part, created the negative GDP growth. We have to wait and see, and we won't be able to see until sometime early August what the number came in for this second quarter. But we have a stock market that's overarching in such a way, such negativity and such fear at this point in time, and such volatility that it feels like our overall economy is slowing down or is growing negatively. A way to really see the overall economy, I don't want to debate whether we grow negative or not, because we will have to wait and see, but when we look at the earnings reports of companies, as companies are coming out with earnings reports, it at this point in time is a mixed bag. But for the most part, what companies have done is they have passed the inflation on to the price, right? They're still passing the inflation issue on to the price, and the prices have still gone up. So for the most part, it's us consumers that are bearing the brunt of supply chain issues, inflation, et cetera, et cetera. We're seeing companies still coming out with strong profits after quarter one. So here and there, we saw some major changes. Companies, obviously, like Netflix, Peloton is a good example. A lot of your technology companies, Amazon, is coming out with negative or below expected, even Apple. But I looked at Apple's earnings report, and my goodness, they were off by something like 0.3 billion worldwide. Their expectation was 52.8 billion in profits, and they came in 52.3 billion, and the world falls apart. It tells you about the majority of the negative sentiment that's in the markets. So I can't tell you the economy is growing. I can't tell you the economy is not. We expect a little bit of a slowdown as pricing is becoming more and more expensive. The natural response for people, the consumer, is to kind of slow spending down as well. So don't expect the second quarter to be a negative number. Most of the economists don't believe that we are in recessionary times. And some of our money managers that are giving us very strong reports believes that word recession is probably more pushed out towards the end of the year, even as far as 2024. So even if I say recession in 2024, doesn't make people excited, but the reality is I don't think it is as much of a fear as the markets are indicating at this point in time. We will have to truly wait and see. So let's look forward. As we look forward to this quarter, as we look forward to the next part of the year, inflation could remain high. Like I said, it's still 8.2%. That's a high number. We don't anticipate that to plummet fast. Spending, like I said, will slow down. The consumer is looking at their dollars. For the most part, our economy is fueled by a consumer economy. And so obviously people are buying a little bit less because it costs much more money. Still, another indicator we look at is how much liquid cash does people have. And the liquid cash that most people have in their bank accounts are still very, very high. It's much higher than it's been in a long, long time. We also look at things that is strong to the economy, that positives, is the fact that we have unemployment at such a low rate. We have job openings, about the ratio of job openings to people that are unemployed is about 1 to 3.5. So still companies are looking for great team members, like Jeremy's to us, and still hiring in a big way. So those are positives for the overall economy. And then, as we said, volatility will continue to go on. It's just a factor of what we're dealing with. I will say that this week, it was an exceptional week of volatility and downward pressure. I wanted to ask Jeremy to join us today, just to say or share with you a little bit more about what are we doing at the LifeWealth Group? How do we see investment styles? What is our philosophy? And you're looking at a pretty busy slide. Many of you have seen this slide, but I'm going to ask Jeremy to kind of walk through this with you and just to say to you, what do we see? What is the contribution that we can make? And then I'll kind of take from there and come back to the conversation, sharing with you what's working at this point in time and what's not. So Jeremy, how would you describe our philosophy at the LifeWealth Group as the way we're managing money for our clients?
Well, we have access to a platform of active and passive money management, but we typically lean toward active money managers. Sterling Capital is one of those. We use BlackRock. More tactical managers or just Tactical Edge. We use other managers that typically will have a philosophy of not passively managing their allocations. The passive managers we typically would use in a tax sensitive environment that wouldn't trade as often or try to make asset allocation changes as more frequently. In the retirement accounts, we typically lean toward the active managers that will look at the overall economy and the different points in the business cycle, and they'll make strategic decisions on the asset allocation based on the quantitative analytics that they see in the market. And we typically lean toward that type of investment philosophy of a hands-on approach to looking at the overall market and the quantitative analytics that drive asset class returns and trying to predict what the asset class returns will be in the short term, 1 year or less, versus a 10-year or a 20-year investment buy and hold philosophy that's more rules-based and simply just looking at whether they fit the mold of an idealistic asset allocation. And so we like to change as the conditions change and make those asset allocations as much as we can. And we try to be sensitive to the tax situation by doing a lot of that in the retirement accounts that are tax deferred, and then maybe utilizing a little bit more passive allocations in the taxable environments. So we build that investment structure based on your retirement plan, and with the tax sensitivity involved, as well as the active management in the tax deferred accounts. So we have a platform with both prevailing investment philosophies with a leniency toward the more active managers. With that, we have, traditional managers who do asset allocations quarterly, dynamic managers who look more monthly, and they'll make decisions on a monthly basis. We have tactical managers that will make drastic changes as needed intra-quarter, which could be daily or weekly activity. And then we also have specialized solutions that we can come into play, hundreds of different types of investment styles that we can utilize in a portfolio. And we put together our allocations just based on your retirement plan and the type of risk we want in a certain tax environment. So that's kind of how we utilize our platform.
Thank you, Jeremy. That's very, very well said. I guess it's easy for me to abbreviate. We try to do our absolute best to be proactive with the way that we manage wealth in an up market as well as in a down market, but understanding that nobody can see the future. And so normally when we look back over this last 5.5 months with extreme volatility, we're seeing certain investment styles are working really, really well to be defensive. Ones that we've hoped would work better has not worked as good. And then we have some that we needed to make some mid-course correction changes that has become probably more volatile than the NASDAQ. An example of that would be Sterling Focus Equity, whose underlying stock holdings are strong and good, strong companies, but they are just becoming more volatile than NASDAQ. So you'll be getting some future videos of me communicating this. But myself and the team, we are doing everything in our power to be able to provide you communication, as well as the fact that we generally care about the way we're investing monies. And we are really thinking through what's working at this point in time and how better to protect downside. But we are human beings. We do not see the future, and it's very, very difficult to see exactly what styles are going to be the best styles to look at. That's why we use a diversified approach with different investment styles. There are some of these investment styles that are working well this year that are pretty defensive. Concepts like dividend-paying stock. We were innovating this in the beginning of the year. We created a high-yield portfolio that is custom-built here in our practice. For some of you who have transitioned already out from some more volatile positions, knows exactly what I'm talking about. We have a yield portfolio. In down markets, there's a few opportunities. One of those is you can buy what's called yield. Yield is interest payments. So if I have a $100,000 amount of money that pays an interest rate of 5%, when the markets take the underlying holdings down to $90,000, then I'm buying at a discount. Therefore, my yield, forthcoming yield, will be something in the 5.6% range. So what that means is that in down markets, I'm buying into future income streams that's coming more from dividends, interest, real estate investment trusts, all kinds of different income sources. And it puts the portfolio on a more predictable pattern where I got 5 to 6% of income coming in to me. When you buy that on down markets, your interest rate actually goes up, and that's a really good opportunity. We've seen those portfolios be resilient during this period of time. We've seen the unique possibilities portfolio, which is a specialized solution for us, being a very resilient portfolio as well, because it is more based upon a theme that's based upon the Fed bringing out funds to be able to invest in the economy through infrastructure, and investing in those specific companies who are the benefactors of those funds has been very, very defensive for the year. We have introduced tools and we'll talk to you about tools that protects downside, things like structured notes that gives downside protection through buffers and barriers, equity indexing that's available inside of annuity contracts and life contracts. A combination of those type of ideas are bringing stabilization. So we're trying to bring stabilization through downside protection tools and management styles and different management styles. And we are succeeding in some wonderfully, and we are failing in some. So we're just human, and that's the reality. But we're learning through the process. So as we're talking with you on a one-on-one basis, I will say this is the most important part of our discussion for today. It's like it really is back to basics. And for us, basics means going back to your plan, giving us a call and discussing your plan as it relates to volatility. For some folks in our conversation, we are making transition. For some folks, we are investing more money. For some folks, we're keeping the status quo. It's very unique to your unique situation, your risk tolerance, and your very unique plan. So I invite you to have discussions if you want further to talk about your portfolio. Another reason I asked Jeremy to come and join us today is because Jeremy got a wonderful promotion that he's well earned over the years with us. Jeremy was in our financial planning department and was doing a phenomenal job, was my wingman in many different kinds of meetings that you all were in. But the practice have been growing, and as a result of it growing, we needed to have another lead advisor on our team that can help Shay and I with reviewing your specific accounts and your situations. And so Jeremy was so integral involved in the planning for most of your cases that Jeremy then stepped into the lead advisor role. So Jeremy, how would you describe the difference and how much do you enjoy the lead advisor role versus the planning department?
For me, the best part is being able to craft the plan for the client just from the beginning to end, and being able to customize the entire plan when it starts with the cash flow, the insurance, the investments. I just enjoy getting to know people and to be able to customize things for them and to be able to service them very well. So it's been a great experience stepping into that role. So.
Awesome. Thank you, Jeremy. Thank you very much. So I'm going to share just a few updates on the practice, what's going on. We are loving our LifeWealth Women from Wonder to Wisdom. This is for our female clients. Most of our, they kick us guys out of the room, but LifeWealth Women is a monthly meeting that Shay is leading here in our conference room area, where all the women are together and they're having a tremendous fun. They have always a great speaker, and they talk about some of the basics, talk about being back to basics, talk about the basics, terminology. A lot of our actual clients are now representing too on specific topics that they're doing. And so they're doing community service events together. There's a travel concierge experience that's unique for the women, and then other social and engagement opportunities that's available for our female clients. And I think everybody loves it. It's from single women, widows, divorcees, or professional women that are coming here. I think Jeremy and I are jealous. We take a snack when we see the door closed, but we're not allowed in. So we invite all our female clients to join us with that, and you'll have some great fun. Here's some dates. June 2nd, the topic would be walking through fidelity statements. Jeremy and Hilton is invited to speak. So again, I'm not allowed in. But they're going to walk through how you'll read your fidelity statement. July 7th is how to use the financial apps, Fidelity, eMoney, Investment HQ is another tool we have that helps you see your plan as well as your finances. Then we added a new team member, Claudia Allen, and we're very excited to have her join the team. She's helping us out on the operations side. She's coming alongside Michelle and Brad Malloy with the processing of paperwork. Very, very talented young lady. She has really been in the industry for quite some time. So you can see 14 years. And we just loving her. She moved from Chicago, born in Austria, as you can see. And she's just complementing the team in a big way. So we're excited to welcome her to be part of our team. Then we continue to have upcoming events. We have installed the chef tables. We have our family night where we have our family table. Great time for you to introduce families to us and come and listen to how we help and how we can help your friends as well. Excuse me, I hit the mic there. Then we also have the State of the Market dinner. This is coming up. The guest speaker again will be Paul Peterson from First Trust. And this will be July 14th. I think this is going to be a great event where you're going to get more perspective of how do we see the future. A lot of that fun of that time or a good time is being able to answer questions and look a little bit more ahead, a year, 2 years, what does the markets bring forth for us. On that topic, I will probably share this with you. Good news. The good news I could find so far from what I'm seeing through economists and market commentaries that we've gone through in a big way, that we do on a quarter-by-quarter basis, is that there is a consensus that the market will recover here towards the end of the third quarter, beginning of the fourth quarter. It has a lot to do with the fact that we've swung so much negative and there's so much volatility. And remember, the stock market is always trying to be 6 months ahead. So it's pricing in a lot of bad news already. Coupled with the fact that we have midterm elections, I mentioned that I was going to talk a little bit about that. Midterm elections, a lot of people have different opinions, and I don't want to be political about it. But I think most people right now in the United States are feeling the pinch of inflation. They're feeling the price at the pump. And I think we will have a midterm election that will move us more towards moderate. If that moves us more to moderate, then it's very unlikely that there would be any tax code changes happening for the rest of the year. And I think that will settle down fears. As we can see how Ukraine and Russia plays out, and the world can see that it's not a world crisis. We don't see nuclear weapons coming out. And it's more of a local situation. I think that will settle things down for folks. As we're working through, we see an improvement. So at the moment, the only improvement I see in inflation is 8.5 going to 8.2. But if we start seeing a little bit of improvement, because by that time, the Fed would have raised interest rates a few more times, and it would have already started taking an effect into slowing our inflation and slowing our overall economy. A lot of it has to do with the fact that the Fed plays this very careful and do not overreact. We are not seeing that the Fed is freezing up. That's a specific terminology where you have an interest rate inversion of the long-term interest rate versus medium-term versus short-term. At the moment, the graph is still looking like this. It just means the Fed's not freezing up, because what causes recessions is if the money supply and interest shuts down completely and or reduces a lot and the interest rates goes up. It means the Fed is overreacting. We are not seeing the Fed's overreaction at this point in time. And if the Fed can navigate well through this, that's another positive injection towards markets returning and probably coming back due to an overselling and over negativity that we are experiencing at this point in time. So those are some positive comments that I have for you. Some upcoming events just for the practice. We're partnering with Make Him Smile with Nathaniel's Hope. It's a wonderful volunteer day. Would invite you to come and join us. It's going to be June 4th downtown. It's the Make Him Smile VIP event. This is for families with special needs children. Many of you have volunteered with us, and the last volunteer day was last week at Second Harvest, and it was tremendous to see how many of our clients are showing up, coming together. Eunice and I unfortunately couldn't be there. We were literally moving our house during that afternoon, but it's fun to see. And the team has been involved with Make Him Smile, and we definitely invite you to come make a difference, and it's a tremendous event. So that's coming up as well. Always, we thank you for your introduction to new clients. We have our Ambassadors Club, Ambassadors Elite Club, as a way to reward those clients who have referred us. And we have a very strong inflow of new clients coming in because most people are looking for answers, and we are providing them, and we are giving some downside protection tools. So very, very much thank you all for introducing us to others. Please continue to do so. We would love to promote more folks from our planning department like Jeremy to become lead advisors. And then as much as this is possible for you, don't look too much at the stock market. Don't look too much at the red. Enjoy the journey. There's much more to life than stock market. As we all know, we are here for you. We are working with you in this difficult period of time. And I am now going to open up the conversation. If there's any questions that you would like to ask that are real specific to markets, economy, or anything, like I said, the smart man is here next to me, Jeremy. So I'm going to look here at the chat screen to see if there's any questions that any of you might have. Otherwise, if there's no questions coming through, then we can conclude you in the next 3 minutes or so. All right, I don't see anybody having any specific questions at this point in time, but if you do, please go ahead and put it in the chat box here. I think a question that we get asked a lot at this point in time is really, hey, what do you think the market's going to do? Are we at the bottom yet? That's a big question we're getting asked. And as I'm asking those to our Chief Investment Officer, Tom Siamandis, and others that we also read and we follow, I'll say this to you, that it appears to me that there is a support level or a support level on the S&P 500 that's at about 3,800 points on the S&P. This week, we did break the 4,000 mark. We dipped down to about 3,910 in that range. But as I looked just before recording, the market is bouncing back from that level. So just remember, on the other side of a person selling is a person buying. And the people that are buying on the other side are smart. They're buying into a low market. They're typically institutional investors. They have cash on hand. So the best advice I can say to you is to, if there's cash on hand, think about phasing money into the markets over a period of time as we are trending down. That's the best advice. If you want to buy more stability, the yield portfolios, as I said, you're buying into stable yield, which is a good concept as well. But most important, let's have a discussion. Let's look at your plan again. I'm so thankful that folks like Jeremy, Joe Veazey, Hilton, Joe Continelli, and our team are building plans on a day-by-day basis because the plans is what gives everybody the perspective of what you specifically need to do as a result of this volatility. So Jeremy, thank you for joining me today. Congratulations on your promotion. It's awesome to see you love on our clients and speak truth and bring perspective. I thank all of you joining us today. So have a great rest of the day and a great weekend for you.